It is everyone's favorite time of the month as we do stocks to buy. We love stocks to buy. We love it. I mean, this is just a great time of the month. We love to see it. This is for August. Um, Definitely, market's still at all-time highs, so you really got to go searching for some quality companies right now. I have three or four completely different sectors here today, so I did spread it out a little bit. I could say go all in on tech because guess what? Tech is going to be roaring still, but I spread it out for you and I hope you really enjoy. Don't take that out of context. So we start off, as I have to, with Facebook. The absolute earnings smash that they posted that led them to an 8% gain on Friday. And guess what? There's plenty of room to grow. So my perspective on these companies I have for you today, they're long-term picks, right? These are long-term picks. I'm not talking about things that I want to sell by the end of the month. I say these are good values to buy now and enjoy 5 years down the road. So Facebook is likely my favorite stock for the future. Just being honest. For the next 5 years, Facebook has the best risk-reward potential or really prospect out of any stock that I see right now. I think Facebook has the most potential reward for as little risk as you can get, because this is a company that is absolutely a monster. And I must say, even after today's gain, which may seem crazy, the stock is only up 21% today. Or, I wish, 21% on the year. This is a stock that has benefited greatly from everything going on right now. I mean, this is a stock that benefits from the current environment because more people use the platform than ever. And there's a lot of controversy regarding people pulling back ads, and we'll certainly get into that. So we'll dig a little bit deeper in just a second. First, we have to explain what Facebook is. Obviously, you know Facebook from Facebook, but you got to know them as Instagram, right? You got to love it. WhatsApp. By the way, WhatsApp was the most downloaded app last year, in case you were curious, and it was by a good margin. Right behind them, Facebook. Right behind them, Messenger. Right behind them, Instagram. So this is a company that owns last year's top downloaded apps. They own 4 of the 5 on there, the other one being TikTok. So they own 4 of the 5. And Facebook may eventually make a TikTok clone, who knows. But they also own Oculus VR. And this is in their other revenue category. And obviously, the throat won't clear here. I'm sorry. It's rough out here. But Oculus virtual reality gaming is only really in its infancy. And Oculus is the leader in it. Just being honest with you. So this is a company that, as virtual reality continues to blossom, and I don't think it's just a trend. I do think this is a long-standing thing. Oculus is going to be rocking it. I mean, what can you say? It's a very good company. We also have, I did want to mention WhatsApp still, and it's really its infancy as far as monetization is concerned, but there's a lot of money to be made on WhatsApp for them. That's all I could tell you. If we look at the financials, it's what gets me giddy. You know I love financials. Trailing P of 32, forward PE of 31.75, which is also, I don't think, a fair forward PE. Just being honest, I don't think they're necessarily equating that properly. I think it should be in the 20s, 25, around there, if you're looking at my expectations. But, analysts can eat my butt. But price to expected growth of 1.26. I mean, this is what I would call cheap valuation for a tech company that is roaring. Tech company that's roaring, this is cheap valuation. I don't think you can deny that. In fact, you look, and you look at this chart on revenue, and you just see the story really. From 2019 doing $70.6 billion to the year prior doing 55, year prior doing 40, year prior doing 27 billion. This is a company that grows money like no one's business, and all the while, the net income line is beautiful. So last year they had $5 billion in expenses due to the Cambridge Analytica scandal, so that's why they were down. But the year prior, $22 billion they brought home in net income, only bringing in $55 billion. So this year they brought home $75 billion, with a net income of $23 billion. Could you imagine that you're bringing home 1/3 of your total revenues in profit? Are you kidding me? That is incredible. This is a company with a balance sheet that is better than really any company I've seen, just being honest. It's one of the best balance sheets I've ever seen, and it will continue to be because the company prints money like no one's business. This is a company that is just wonderful. That balance sheet alone will keep it for a long, long while. So we also have, as far as the analysts are concerned, I don't like analysts too much, but this year expected to have an EPS of $7.29 versus $7.43, and this is a weaker year for them. And next year expected to bring home $9.74 in EPS. That's right. That's incredible growth. And you're telling me that this forward PE ratio is it's false. The forward PE ratio is not right. I'm just telling you how it is. I don't know why Yahoo Finance has it wrong, but this is a company that's going to be growing this EPS line pretty rapidly, and they continue to. The revenue is an exciting part too. This year they're only expected to grow 9.7% to $77.56 billion. I can get that to an extent if you take into the fact of quote-unquote advertiser boycotts, in which these are companies that are literally just trying to seem like they care, but they don't. Just going to throw that one. It's what we call pandering. But next year expected to bring home $96 billion, a 25% growth. So they're expected a little bit of decline this year, right? By decline, I mean decline in growth. Decline in massive growth, I should say. 10% growth is massive when you're talking about $70 billion. But next year, 25% growth expected? Holy crap, and that's no shocker. The advertisers already are coming back, by the way. I frankly don't think they ever left. It's entirely a pandering scheme where they wanted to look good to the masses, because Facebook and their evil, they don't censor enough hate speech for them, But really, the vast majority of people are very supportive of Facebook's policies, and these companies realize they're the loco ones, pandering to the mob, and therefore they're going to be advertising again. Come on now. You can't alienate people like that. But what I want to talk about with this company, again, is the benefits of right now. Look at this chart of daily active users. This is incredible. This is a chart that continues to rise, and the growth has been a lot more steep in the past 2 quarters because of people being locked down, and there's not much else to do besides get on Facebook platforms and communicate through people through those, because you can't see them physically, you know what I mean? So this makes plenty of sense, but this is massive growth. We've done it in monthly active users. Average revenue per user finds growth. Daily active family daily active people up. It's all up. Revenue up. But what I want to bring up here is advertising revenue. So we've got companies like Google facing big losses in advertising revenue, right? And then you have a company like Facebook. Twitter as well was in the same boat. They lost a lot of money from advertising revenue. Big decline there. Facebook here says, I think you can shove it, Twitter. We grew advertising revenue 10% in the middle of everyone saying that we're going to quit advertising with you. That's right. That is what I call a hot time. Not only were ad rates down, but people were not trying to sell advertisements on their platform. And Facebook says, I'm going to grow you year over year. Okay, I'm going to grow. I don't know what you want me to do about that, but I'm going to grow 10%. So you can kind of suck it. So I respect them for that. Very good stuff by Facebook, and that's why I'm a very long Facebook investor. Long as in terms of I like the stock, for long term. Not that I am long in any other way, unfortunately. Okay. After them, we have Target. Target. I had to throw some retail in there, and I think Target was a good pick. And I think there's many reasons why I say Target. So Target for me is a company that's on the forefront of digital expansion into retail. As far as e-commerce is concerned, I think Target's on the forefront. And obviously dollar-wise, Walmart is, but I think Target's the most full-fledged. Obviously you know who Target is, right? retailer, massive retailer, love doing these sales. Target does everything. But I want one thing to point out on this screen. It's right here in the middle of your screen. Contactless shopping options. So here is the platform that is massive for them. Drive up, online shopping, right? Online grocery pickup. It's something that Walmart does, right? But Target's been doing it for a while, and people love it doing it at Target. They love doing it. And there's more of a consumer base doing it at Target as far as percentage compared to their total. So this is a massive option for them, especially in times of people not wanting to have people touch their stuff. Contactless shopping is where it's at. So it doesn't alienate anyone that doesn't want to go out. And we also have same-day delivery from Shipt, which is a $10. It's a free with a red Shipt membership or $10 per order. A lot of money to be made there. Shipt is growing massively as people want same-day delivery. I don't know why they're advertising the world's worst album right here, though, and also why Taylor Swift looks like that, because I'm sorry. I don't know why she's so explicit now, so she needs to quit being a brat. Looking at the statistics on this company, market cap of $61.6 billion, trailing PE of 22.9, and forward PE of 26. Seems somewhat high for the history of this company, but again, I want to mention that this growth comes with a different level of valuation than it previously did. Price to sales of only 0.79 is pretty massive too, and enterprise value to revenue 0.92. Very cheap historically for this company, very cheap. And obviously we can see this. This is a company that brings in, from a trailing 12-month basis, $80 billion, right? And we need to mention, again, market cap. Do you see the market cap? $61 billion. Trailing 12-month revenue, $80 billion. Excuse me? That's what I would call undervalued, right? Very undervalued. So, I think there's PE ratio can be high, but I honestly I like comparing revenue to market cap. Market cap is a big way to value stocks, and investors are always down on retail. I feel like that's just an industry that gets just smashed. But it deserves more credit, especially with a company like Target, with what they can do. I did want to mention net income line, pretty consistent around here, right around or under the $3 billion mark. So consistent net income, it's good positive earnings for this company. You should see slight decline with obviously these new tech options. There's going to be slight decline. They're paying their associates more now, so you'll see a slight decline probably in net income, and that's expected on this. So what I like to see is the revenue consistently growing, though, out of a retailer. It's growing at a decent rate. As far as analysts are concerned, expected to do $4.94 in EPS this year. And again, it's going to be a bad year because of there's so many more expenses that come along with Corona than they did previously. Year ago was $6.39, but next year they're expected to grow from what they did. $6.39, they're expected $6.76. So that's why the PE ratio is a little bit funky for the company. But I think valuation is cheap for this company. Cheap, fun. Revenue-wise, they're expected to grow 6% this year. I think that's light. I just got to be honest with you. For my anticipation, and I work in retail, so trust me, I know my life sucks. But this company likely should expect to see a 10% growth this year in terms of revenue. I expect 10%. Next year only expected 1.6, slowed down growth. I frankly don't see it. I'm just going to be honest with you. I think this momentum will continue on because of the increase in customer base these companies have really gotten. And if you impress someone with your services, either online, your online grocery pickup, your just in store, you keep those customers, right? So, and that's the main goal. And I think they've been doing a great job of that, no doubt. Just need to stay out of Target or politics. Target, please do that. And I did want to point out their most recent earnings, which is a while ago, right? To point out the benefit of this digital sales growth. Digital sales for the last quarter, grew 141%. 141%. Not doubled, 2.5 times, right? 2.5 times the growth. Digital sales accelerated every month this quarter, 33% in February to 208% 82% growth in April. And I guarantee you, May's growth was even bigger. So this next quarter coming out, it's going to be a beautiful, beautiful blowout quarter. That is just incredible. Stores fulfilled nearly 80% of Target's first quarter digital sales. Oh, yeah. I just want to mention that. This says stores. Stores. So what that means, obviously, is your online grocery pickup. It also means shipping from store. So these are companies that, or this is a company that, obviously, they don't want to overflow the warehouses that they get the merchandise from. So they're sending more to stores. And from there, those stores will ship out merchandise after they package it up to the consumer directly, so they can get same day shipping that much easier. Because if you're shipping it right from, down the street, you get it a lot quicker than if you're shipping it from a warehouse in a different state. Same day services, which is order pickup, drive up, and shipped, grew 278%. That is incredible. Incredible. Massive growth there, and expect it to continue. This next quarter, you're going to see numbers very similar to that. So that's my thesis on Target, and I think long term, this is just a beautiful play, even at these levels. The stock's at high levels. Next, we have, believe it or not, we got a real estate investment trust there. Some people will think this one's wild of me, right? Arbor Realty Trust, stock just rose 6%, but there's reasons for it. This is a beast of mine. I don't want to say it's a beast just because it's in my portfolio, but I mean, this is a stock that is a very high dividend yielder, but also a very good in terms of market gain as well. This is a beauty. I'm up $154 on this stock, or 28%, and that's before the beautiful dividend this company pays, and we'll get into the beautiful dividend in just a little bit. So, as far as the fluctuation of the stock, it's been a wild year. The stock is still down 16% this year. It had reached highs of over 52-week high of 1577. What is Arbor Realty Trust? Well, this is a company that makes profit off of loans. Multifamily loans is a major portion of their business. And it's a scary market for that, right? People foreclosing and defaulting on loans quite a lot. But Arbor Realty is a company that is super well poised in my position for the current environment. I think they're really well focused on everything going on. I wish I had purchased this thing a lot more when it dripped down to $350, but I was buying every single stock in the world, so sorry. But very good stuff for this company. As far as the financials are concerned, not usually something you look at for these real estate investment trust companies, because you should value these a little bit different. So market cap of 1.03 billion, price to sales of 3.61, and price to book of 1.05. Pretty cheap there. You see a slight decline in revenue this year, all entirely because of, not dishing out as many loans, because you can't necessarily trust as many people. But I think the recovery comes next year. I really do. And there's a company that's not like it's struggling right now either. So they also recently raised their dividend. Every real estate investment trust out there holding tight, or they are stagnant for the most part. And Arbor Realty Trust rose it by 1 cent, which is only 3%. But what can I say? That means a forward yield of 12.94%. And high yields can scare some people, but this is a company that's been super consistent with this, and I trust them. If we look at the dividend history on this company, first off, that payout ratio is fake, so don't worry about that. That is not an accurate one. But as far as dividend growth, they've been growing for 8 years, really much since the financial crisis, which is not a shocker. But this company's been raising the dividend consistently over the years now, which is very exciting to see. So I trust this company and what they're doing, and how they're able to. There was a special dividend, by the way, so that's why there's a downward movement there, and that's why it's red. So don't think that was a decline or anything, but look at this. That's a good chart for the past 8 years. We'd like to see it. Really, if you scroll down to 2012, it's a good chart. And I don't think necessarily they're going to find a decline. I really don't think they will, but I'm, pretty happy for this stock. They're really rocking it. And if you look historically, obviously, company, it used to trade at higher levels before the financial crisis, and I think there's still a chance it gets back to those levels. I'm not going to lie to you. But this company's beautiful. That's all I could tell you. I think there's more gain to be had, but regardless, the dividend is beautiful, and I enjoy the dividend reinvestment that I get from the company. I get several shares every time I get a dividend reinvested on this company. So if you think about it that way, 67 shares. I mean, most recent dividend was off of 65 shares. I got literally 2 shares out of it. You know what I mean? 2.5 shares out of it. 1950 reinvested. This year or this quarter, it'll be around 22, which means I'll get another 2 shares, which I love. I love to. Oh, that's why dividend reinvestment's beautiful for me. But that's it for Arbor Realty Trust. Hope you enjoyed it, and we're gonna end it with a speculative stock. So we touched on every industry today. That's all I'm telling you. We touched on every single industry. Last stock is going to be New Age Beverages. So, New Age Beverages is obviously a drink company, as it's in the name. So, New Age Beverages, definitely definitely, when you think about spec stocks, you'd think about this one. I mean, it makes sense, but as far as the valuation is concerned, I like it. If we look at the brands, which is obviously important, brands are important for this company, and they've recently just expanded too. So brands wise, you see Nestea. Sorry, just was conducting a little business. These are some brands you might have heard of: Volvic, Bucha, obviously a kombucha, which is gross. You've got Evian, which is probably the water you've heard most of out of any of these drinks. Probably Evian, I assume, is the one you've heard most. There's Zing Tea, probably heard of that. Enhanced, Tahitian Nani, Shape, and Timana. So tea is big, you know what I mean? Tea is big for this company. They're also known for the Bob Marley brand of teas, which are in the Zing category. So, one thing I did want to point out is a recent expansion of this company. So they've partnered with 5 different companies, which is weird. The main one being ARIIX, which is one of the fastest growing direct selling companies with over 17% annualized growth rate, penetration in over 35 countries, and leading nutritional performance portfolio. So this is a company, New Age Beverages, focused on expanding what they're providing. They're massively expanding what they're providing. It's pretty good. You have Zenoa, which is established in 2016. It's the largest presence in Japan, which is good for expansion, obviously, and a portfolio of superfood-based dietary supplements, beverages, and fermented foods. So guess what? On the forefront of hip and trendy, but it gives them that total market expansion that they're looking for. Global expansion is important. Limu, which is LIMU, is the global leader in Foikidin, rich seaweed-based nutritional products and beverages, which is disgusting. But as the leader of that as a super nutrient, again, it just expands the products that exist. Now, all of these are gross things in my opinion, but a lot of people are into this stuff. Mavi is a DNA mapping and wellness company with predictive genomic sequencing with a range of nutritional products customized to the individual's DNA makeup. Really cool sounding. But again, it's all about expansion. It's what I talk about, providing more products for people. And then we also have Shannon, which is an award-winning Indonesian skincare and beauty company. So not only are they doing food-based products, they're also working on skin products. You know what I mean? They've got everything in the portfolio now, which together these companies should make a $500 million in terms of revenue total combined. and that's when you want to dip into the valuation for the company. And it had shot up one day over $3. As you can see here, it shot up over $3 for a little bit. It doesn't show it, but 52-week high of 385. It was definitely just a one-day experience, but the stock's still riding a little bit high. Looking at the valuation, trades at a market cap of $201 million, which means a price to sales of only 0.67. That's incredible, and an enterprise value of 0.88. For a stock that is, I think the stock just gets a little bit neglected, from investors. So total revenue trailing 12 month of $259 million, which again should expand next year to $500 million. If we're looking just off this company for now, though, the question obviously comes with net income. It's not a beautiful company in terms of earnings. So net income is a line that is not doing fantastic, but we're seeing some change and the turnaround's happening. So total revenue of $259 million, market cap of $201 million. Seems a little cheap for me, right? The valuation's cheap in this market. There's no doubt about it. EPS expected a negative 33 cents versus negative 58 cents of a year ago. And next year expected to bring that to a negative 3 cent number. Really nice to see that growth there, and should be profitable by 2022 if all things go as planned, which I think they will, especially with this expansion of these new companies. I certainly do. But the revenue is definitely a good number from my perspective. I think these analysts have it wrong. Only expected to grow 5.6% this year. I think it'll be a little bit higher. Next year expected to grow 10.5%. You like to see that too. And that's before the acquisition too. So I like the acquisition, and I think it provides a lot for this company. So I really hope you enjoyed this. This is the stocks to buy for August, and I hope you consider some of these. Give me some feedback in the comments if you will.